And then on that note, it's a pleasure for me now to introduce our first speaker of the morning, Severus Smuts. Severus is a director at Deloitte, and he will be discussing with us the implications of VAT on mergers and acquisitions. Welcome, Severus.
Thank you, Gerard, and good morning to everyone. I see a lot of familiar faces. Also, a warm welcome to our colleagues from SARS, which I see is also here. Why is it important to look at these issues in terms of merger and acquisition transactions? Well, firstly, it's a high-value transaction, and there are a number of rules that one needs to consider in order to make sure that there aren't any pitfalls. Sorry, I'm just trying to move this along. Anyway, just to continue while we're waiting for the screen, I think that the most important thing is to distinguish between the Section 825 and the going concern requirements. And what I'll cover today is the Section 825, which really deals with the VAT concession involving the rollover relief concessions in the Income Tax Act, the going concern transaction, some transitional measures and what to watch out for, and then the VAT registration process. We'll look at some of the transaction cost issues, and then we'll just deal with the unincorporated joint ventures. So as I said, I think there are a number of requirements to keep into account and to consider when you do a deal in terms of M&A transactions. And I think the reason why you want to get it right is that it is a high-value transaction, and if you do get it wrong, then you're going to suffer some consequences with regard to penalties and interest. Just looking at the quote there at the bottom, I think VAT's become quite an attractive tax system, as Gerard also pointed out. I think the trick now that we've got VAT, and just maybe a general comment in terms of VAT in South Africa and also in Africa, is to find a common ground in terms of where to tax transactions. I think the OECD and ATAF is doing good work to ensure that the tax regimes in Africa look at VAT the same way. I think that's important because otherwise you may find that you tax the transaction in two different jurisdictions, which is obviously not desired. Looking at the Section 825, just a bit of history. The reason for Section 825, as per the explanatory memorandum, was really to avoid unnecessary tax costs. If you find two partially exempt organizations merging, or, for example, a bank, then you find that there were unnecessary costs as a result of the basic principles in terms of VAT, and specifically when it comes to Section 11.1e, the Section 18a adjustment, and also the 16.3h adjustment. So I think the idea was really to facilitate the transaction and ensure that the two businesses are merged without any unnecessary costs. A Section 825 transaction obviously requires you to, which is a non-supply for VAT purposes. In other words, the supply is deemed to be between one and the same person. So it's just putting one thing from the one pocket to the other side. Arguably, you should then put the transaction from the seller's point of view into the field 3 of the VAT return. Just a bit of high-level information. So I'm not too sure if many of you are aware, but there was a draft interpretation note issued by SARS quite a while ago, and it dealt with the Section 825 section prior to the recent amendment.